This is INBrief with Victor Mayer, partner at Pantheon. First of all, Victor, thank you very much for making the trip down from Singapore to participate in and attend the Inside Network's Investment Leaders Forum Noosa 2026.
Well, thank you for having me, James. It's always a pleasure to come to Noosa.
And living in Singapore, and as you do now, you're used to this kind of weather?
Exactly. Humidity is easy to deal with here.
Victor, private credit secondaries have garnered a lot of attention recently. They've become one of the big growth stories of the marketplace. Why is that in terms of what problem do they solve for investors?
That's a really good question. I think the way we think about this is very simple. You have the three dimensions of credit secondaries, and the first one is duration. When you invest into a primary credit portfolio through a secondary transaction, you would buy these assets 2 to 3 years after the original issuance. And so we have an opportunity to re-underwrite, the duration and the quality of credit, which gives our investors a second layer of filtering of quality. So that's important. The second one is diversification. We build globally diversified portfolios by geography, by credit type, by fund manager, by seniority, by duration. And so that gives a certain form of resilience to the portfolios that we manage. And not only that, but the largest positions in our portfolios would tend to be a little bit smaller than what you could find in more concentrated options. And the third one is discounts. I mean, on the secondary side, as you know, James, we are able to price in, the actual credit quality and the actual credit performance on the way in. And so those discounts will typically provide our investors with a slight buffer against any form of credit dislocation or credit defaults on a forward basis.
However, private credit has attracted a lot of headlines in recent months, Victor, not all of it positive. What do you see in terms of the current risks in the marketplace, particularly in that primary market?
Well, the risks are, first of all, based on perception at the moment. I think there is a disconnect between the actual credit quality that we see in the tapes, of the portfolios that we acquire on the secondary side. And so I fundamentally believe that the credit quality is still robust. I mean, credit underwriting is a risk management practice. I mean, you're looking to really minimize the risks on the way in. And so that gives you, an ability to manage volatility. So that is still going on. The industry hasn't given up on credit quality. Now, what we have also observed on the primary side is the construction of unsustainable liability structure. And what I mean by that is broadly, available leverage, used in what could be closed-end or open-ended semi-liquid structures. And that for us as a secondary firm is a fantastic underwriting opportunity, because when the duration of a credit instrument meets, a highly levered, structure of liabilities, that's when disconnects happen. That's where the mismatch happens. And that's where, as a secondary firm, we can really lean in and provide liquidity to those, liability structures.
For advisors who are looking at the sector but really want to minimize any mistakes, what are the really important markers they should be looking at in terms of manager quality and capital preservation track records?
Well, the first one is there's no shortcut to greatness, on the credit sides. So investing with managers who have been through cycles is absolutely key. You want to have an ability to look back at the performance patterns into those portfolios, and not just in a rising tide, like we've had from 2015 to the late 2010s, but also in more dislocated environments that we've had through COVID or, back in 2022 during the rate hike period. So, having the ability to underwrite that on a backward-looking basis and spotting the managers who have, reliable, sustainable credit underwriting, risk-taking, frameworks. The second one to note is, as an investor, when you look at your risks, what you want to avoid is being too narrow into a specific strategy on the credit side. I mean, private credit is not a homogeneous market. You have a number of subsectors within private credit, which all have their own respective risk rewards. And so as an investor, in particular, looking at our, institutional investor base, the way they think about it is diversifying by credit type, geographies, and also looking at, expected duration profile. And if you build that globally diversified multi-credit, asset strategy, what you find is more resilience, going into a potential downturn. Now, the final thing, and I want to spend more time on this, when you go into credit, you have to find managers who can underwrite performance through volatility, right? You need to make sure that the way your risks are underwritten is sustainable, so that if ever something happens, you can, use all of the leverage, all of the tools at your disposal as a leverage provider to effectively protect your downside. And here, what we find is in the mid-market, where we like to spend most of our time, the quality of credit, may it be through the documentation or, the restrictiveness of the covenants, or our ability to define the risk KPIs with actual disciplined, fund managers is very key. So, combining your diversification with investors who have gone through the cycle and having some form of a mid-market quality of credit in your deployment is what we think would generate good returns for our clients.
Victor, over your career, you've worked in several of the world's leading financial centres. Across that career, what stands out to you as a piece of leadership advice that you've received that really still holds strong and resonates with you still?
I think there's a temptation in the industry to be, that willingness to impress, use complicated words, and they always have an answer for everything. But sometimes you just don't know, or it doesn't make sense, and you should feel comfortable as an advisor, as an investor, as a human, in any settings to say no, when you don't feel that it's the right thing to do.
Victor Mayer, partner at Pantheon, always a pleasure. Thank you very much for your time today.
Thank you, James. Pleasure to be here with you.